Coming up today, stocks bounce back, the bears grow louder, Chinese spies, the latest on gold, Kramer says crypto's in a bubble, the hottest stocks from today, and why there is no innovation without speculation. We're living in a golden age, guys. Let's go. And welcome back on quite a bullish day across the board, in a bit of a bump up and risk on growth assets. Crypto finding its feet, along with international stock markets seeing a bump up again in oil. Along with most commodities ticking higher, it was actually semiconductors, one of the best performing sectors today, with a bit of a pullback in consumer defensives. And so why the market rallied higher today is we got news that an October 30 meeting between Trump and Xi Jinping will go ahead at the APEC summit in South Korea. That's provided some positivity to risk sentiment, also helped to bump up global yield, giving bonds a little bit of a pullback today. And the energy complex still bid as we just got fresh sanctions on Russian oil producers. And so the 90-day pause, which the US currently has 30% tariffs on Chinese exports, and the Chinese have 10% extra tariffs on US exports, is set to expire on November 10. So the clock is ticking down to that date. Trade tensions continue to simmer as Trump's weighing export restrictions and bans on China purchasing critical US software. And that was in retaliation for China's announced restriction on rare earth minerals and port fees for US ships. We've still got the US government shut down, some potential positive developments that could get it open again soon as we're approaching that last record of 35 days back in late 2018 going into early 2019 over the border wall dispute. But we are set to get September CPI released tomorrow morning. Headline print expected to come in 3.1% year over year. And what's otherwise been a market lacking data and kind of searching around for a narrative, something to hang its hat on. Along with the Fed, a bit of policy making fog out there ahead of their decision next Wednesday, highly likely to cut rates, and then their quantitative tightening next week as well, which I'll touch on later. And also just a heads up for you guys, I'm about to move house, so I'm taking 2 weeks off doing the daily market review videos starting next week until Monday the 10th of November to complete the move and settle in before getting back to doing daily videos. But to all my members, rest assured, Click Capital Premium services will continue running as usual, and we'll still be accepting new clients in that time as well. I'll just be doing one more daily market review tomorrow before taking 2 weeks off doing daily videos. And stick with me today because I'm going to explain my theory of why there's no innovation without speculation later on in this video. I think you'll find that interesting. Otherwise, just getting into the daily market review as usual, still plenty of fear and pessimism out there. We're still on the bottom of the fear zone. And the latest investor sentiment survey still shows a materially higher amount of bearishness out there, of where people think the stock market will be in the next 6 months after we really flipped back to bearishness last week. A lot of people just not buying into this rally, searching around for a reason why the market should crash soon, including the financial media. The AI bubble won't just take down the stock market, it will hammer the US economy too. No doubt there is some data to support that narrative. There has been a huge amount of tech spending, AI investment that has definitely contributed to GDP growth and probably did keep the economy from going into recession the last 2 years, which we normally see after the Fed hikes rates and we get a lot of inflation. But it could still be early days because most companies haven't fully adopted AI yet. We're nowhere near saturation points, and the efficiencies that AI and soon to be robotics will unlock are huge and will be unlike anything we've ever seen before. But no doubt we will get plenty of bouts of volatility on the way. In fact, we just had a pretty good one these last 2 weeks. Looking at Goldman Sachs high beta momentum index falling 15% in 6 days. That's the largest down move in a couple of years. But like I always say, if you want big up volatility, you've got to be able to handle a little down volatility as well. And try and not load up on the highs, only to puke it all back up down at the lows. So tomorrow could be interesting with inflation. Are we finally going to see tariffs kick in like the experts have been telling us all year? As economists expect the data to show inflation running at 3.1% in the 12 months through September. But like I've been saying for a while, 3 is the new 2. The Fed hasn't achieved 2% inflation for 5 years now. And like I've been saying, I think the government overall is happy to run it hot with low rates and fiscal spending. But I think AI, even in the medium term and definitely long term, will counteract that as it's massively deflationary. And the market's pretty much priced it in as a lock that we will get a rate cut next week. Highly likely again in December as well. And the president himself said massive rate cuts are coming. They're going to install the most dovish Fed chairman they possibly can to take the reins in May next year. And so who knows, by this time next year, we could have overnight Fed funds rate on a 2 handle, which is very supportive of risk assets, tech stocks, meme stocks, crypto, you name it. Big tailwind when the cost of capital goes down. We've also got JP Morgan expecting the Fed to end quantitative tightening next week. That basically means they won't keep reducing their balance sheet and could possibly even be opening the window to quantitative easing. Just that message to the market is very supportive. And whilst there has been a bit of softness in money markets and a little tightness in repo facilities, overall money and credit markets are still functioning orderly. It's not a credit crisis, just a few isolated cases of regional banks and high-risk lenders getting into a little trouble. There's no doubt plenty of low-income consumers are still feeling the squeeze of structurally higher inflation and interest rates. But money market rates are contained, standard repo facility is doing exactly what it was built to do, and bank funding and credit spreads aren't flashing crisis, nor are stress indicators. They're actually very low. And the Fed's winding down its QT because it can. Reserves have fallen towards the ample floor. So this ending of QT is more of a technical move to stabilize liquidity, not really a white flag about credit risk. But long story short, they're topping up their engine oil before it runs low. They're not pulling the car off the road because the engine's about to blow up, so to speak. And I gotta say, it is funny seeing all these big popular FinTubers out there claim there's large unrealized losses on bank balance sheets from open bond positions, like it's some sort of ticking time bomb. They clearly don't understand how held to maturity accounting works, as those bonds are matched to stable deposits, fully capital buffered, and roll off without loss. Unless they're absolutely forced to sell, but that would never happen anyway because the Fed would step in. So in reality, banks hedge their duration risk. They've got way stronger liquidity and reserve ratios compared to the last financial crisis back in '08, and they've all currently got capital cushions well above regulatory minimums. So again, most people don't understand this stuff, so it makes for great clickbait, sensational headlines and videos, so these FinTubers can keep their audience scared out of the market for their benefit only, just like they've done this entire bull market. Can't imagine how many billions of dollars they've caused in losses for their viewers, but it definitely works well for them at least. And this bull market could very well still have a few years left in it. If we are liking the launch of ChatGPT, setting off the AI boom in late 2022, to when the first web browser, Netscape Navigator, launched back in August '95, we still may yet to reach the mania phase of the AI bubble, where things really go vertical, like the Nasdaq did in the late '90s, went up 5x in the last 2 years. And I like this chart here from Fidelity today, overlaying the last two secular bull markets from 48 to 68, 82 to 2000, and the current one from 2009, using a sine wave analysis. And that would suggest this current secular bull market could top out next year or 27, which I would say there could be a chance of that happening as well, especially if we've gone vertical by that point. Because I'd be very surprised that the secular bull market is still going into 2030 or beyond, especially if we've had a massive melt up since then. And come back to the channel tomorrow because I'm going to share with you where investors can hide out when the secular bull market and bubble eventually bursts. With 3 ETFs in particular, I'm already starting to accumulate in my long-term portfolio. The higher the market goes, the more I'll trim some positions and add to these 3 ETFs in particular. And just as a reminder, my long-term portfolio is not a premium service. It's just something I occasionally mention here on the daily market review. As my premium services, stock picks, and ETF portfolio naturally adapt to the market and do have the ability to go partially or all in cash as dictated by the market trends. So that's more long-term stuff, but just getting back to the here and now. We're almost into November, quite a bullish month, especially looking back the past 10 years. Easily the best performing month of the year. Looking at a post-election year as well, and even gone all the way back to 1950. November can be a good month in the market, especially if we've already got a bit of price and earnings momentum out there like we do now. And one of the biggest issues for the market right now is the US-China trade agreement. And after we heard from the White House, the meeting with Xi Jinping is going to go ahead. Polymarkets priced that in with very favorable odds as well, 91% chance, which we could see an agreement going into that or coming out of that. And so I think we will likely get an agreement at some point, but that doesn't mean competition between the US and China is over. It's anything but still a big arms race for global AI dominance, which plays directly into economic and military dominance as well. China really determined to take over America and be the most influential superpower in the world. They're really doubling down on technology, energy, AI, defense, trying to become self-sufficient themselves and not rely on high-end American technology and GPU chips so much, where America still clearly has the lead. But you got to remember the Chinese have a culture of stealing, cheating, and copying. It's very well proven, it's very well known, and there was a piece in the Times today that China and Russia are sending attractive women to seduce tech workers, even marrying and having children with their targets. It's the Wild West out there, says an insider. And again, it's well known in Australia and New Zealand. There's been Chinese spies here for years. It's just how they work, as we clearly have different cultures and systems of governance compared to them. We live in democracies, they live an authoritarian communist regime with a high level of censorship and monitoring of all citizens. But at the same time, they've learnt from the American capitalist system, applied that to their own country over the last 25 years, and that's what's given them a huge amount of growth. Having a capitalist business system with a communist government. And something else the Chinese have been doing, have been selling their US treasuries and replacing it with gold. There's still plenty of bullishness out there. Even JP Morgan thinks gold can hit $6,000 an ounce after it just recently passed $4,000 an ounce. But in my opinion, it would be a smart move move for America, who still holds the world's largest amount of gold reserves, 8,500 tons, even though it's well believed that China have hidden a lot of their reserves and we don't have the clear picture of how much they really own. But with gold at all-time highs, pretty much gone vertical, I think it would make a lot of sense for the American government to take some profits on that and recycle that capital back into Bitcoin, help to retain and accelerate their global dominance in crypto, along with USD-backed stablecoins, which the more of them are issued results in more US Treasury buying, helping to keep rates low, helping to keep the US dollar as a global reserve currency, and not playing into Chinese and Russians' hands of trying to corner gold. Remember, no one's using gold to go and buy bread and milk, but more and more people are using crypto, not only in the digital economy online, but also linked to credit cards now for everyday spending. So crypto is increasingly having real-world usage. And looking at some measures of gold versus money supply, M2, along with Bitcoin, which is still only a fraction of gold's value, but over 2 trillion versus gold's over 29 trillion, is already above US money supply at 22 trillion. And we've only ever seen the percentage of gold's value versus the US money supply higher back when gold had one of its major peaks in history in early 1980, 140%. We're currently at 133%. And so on this measure, which again is mostly gold here, I would say is quite richly valued compared to the value of all fiat currency. And again, just like we saw an all-time record in people searching Google for the search term buy gold, we're also seeing that with the search term debasement, one of the current buzzwords out there at the moment. As there's a strong narrative that the US dollar is going to zero, nobody's going to buy treasuries, therefore we all must pile into gold. But you'll find a lot of that narrative comes from people who are very anti-Trump, even big institutional investors, and they don't want the US government to succeed. I think a lot of those guys would be better off moving to China or Russia, in my opinion. But of course they won't. But again, it just shows we're seeing a peak in narrative out there, which is usually a great contrarian signal amongst all the noise. And so whilst I don't think gold is cheap, I think crypto is in a better position. Got massive political tailwinds, and we just heard that again today with the White House crypto director, David Sachs, saying bipartisan crypto market structure legislation could pass this year. I think it's highly likely to. So they're really opening the doors for traditional finance and crypto to marry each other. And in another bullish signal, we've got Jim Cramer saying crypto is at .com bubble level and advised investors to reduce their crypto holding. Is Cramer right? Did he nail the top in crypto? Or is this going to be another classic bold claim from Cramer we can come back to in 6-12 months when Bitcoin could be materially higher? Along with my preferred crypto, Ethereum, where the future rails of finance and international transactions are being built upon, which may end up eventually forcing these big institutional investors to actually get into crypto for the first time. Just looking at the latest global fund manager survey from Bank of America, 76% of them don't have any crypto exposure. That's a torrent of money out there waiting to get into it, which is now easily investable thanks to crypto ETFs. But again, remember, there's a high level of delusion out there when it comes to this government, especially amongst the older generation, with a lot of them sitting at home watching cable news all day. They've literally been brainwashed to think they're being ruled by a king, not a democratically elected leader who won the populist vote and enacting his agenda as outlined. As I honestly believe Trump could literally end all global wars, even cure cancer, and the mainstream media and all the sheeple that follow them would still think he is the devil himself, because Trump derangement syndrome is an actual mental disease. And Elon Musk could be right that we are living in a simulation for somebody else's entertainment, because we've got the likes of Nancy Pelosi, a career-long politician who, along with her husband, have accumulated $300 million of wealth, significantly outperforming the market thanks to her access and influence over information, who's actually held power longer than most kings, if you look all throughout history. And so I honestly do think that Trump derangement syndrome's actually played a role in the stock market with big institutional money, a lot of them having bailed in Q1, Q2, convinced the market was about to explode, or they want it to explode, that have been forced to chase this rally back up. It's actually been retail investors that have been performing a lot better, with about 80% of fund managers actually underperforming the market this year. And I know myself and a lot of my members are actually outperforming the market this year, as we haven't let our politics get in the way of making money. But pretty much all big tech leaders have jumped on board. They're all actually joining hands to compete against China and accelerate their investments in AI and robotics. We just heard from Meta telling some employees their jobs were being replaced by tech, as once again, big company after big company announcing layoffs whilst they've got profits at all-time highs, along with their capex spending as well. And of course, they're the earliest adopters of tech, so I think we're just getting a preview of what the rest of large cap companies are going to do over the next couple of years. But it's moving on to Tesla with their earnings yesterday, coming in a bit lower than expectations, as they have seen a little decrease in margins, lowering prices, the end of tax credits, but along with increased investment in their new product categories. And we're on the cusp of the Tesla shareholder meeting in 2 weeks, which shareholders will vote on Musk's controversial $1 trillion pay package, which is completely reliant on him hitting performance milestones, making Tesla the largest company in the world with a market cap of $8.5 trillion, selling over 1 million robots. But there is a small group, again, institutions that don't want to see this happen, already running publicity campaigns to try and sway the vote. But like Elon said yesterday, he doesn't feel comfortable going all in on Tesla, building a robot army, devoting his whole life to that, to only then being ousted. He currently owns about 12% of Tesla. This pay package goes through, which I think it should. He'll own more closer to a quarter of the company than along with his large loyal retail base. Guys like me that are going to stick with him to the end and always vote in his favor. He'll pretty much always have control over the company. He won't be able to get ousted, and he'll be able to continue pointing the company in the direction he sees as the best path forward, because he'll pretty much always have at least 51% of the vote. So as a shareholder, I'm all for it. He needs to be heavily incentivized and, more importantly, retain control. The mainstream media will convince you that he's doing it out of greed, because as usual, they don't have a clue on the reality of the situation. As I do think Tesla optimist bots will be a way bigger category than electric vehicles. I think we'll look back in the future and remember Tesla starting with EVs, but they're going to be more a robots company. With Elon even commenting the other day on the article that Amazon is going to replace 600,000 people they would normally hire with robots, with him saying AI and robots will replace all jobs. Working will be optional, like growing your own vegetables instead of buying them from the store. And it's pretty much a long-term trend that's already been in effect for hundreds of years. We used to wash our clothes manually. It used to take hours each week. We've now got a robot to do it called a washing machine. I think it's inevitable we'll outsource more and more tasks and eventually work to robots. And Elon thinks we can have universal high income, not basic income. There'll be abundance, as they'll eventually pretty much be able to do everything, even surgery on us. I think within 10 years, we could be getting our dental work done by robots. Then not too long after that, probably most operation, as they'll no doubt not only be cheaper, but much more efficient with higher accuracy and less error. Just like Tesla's already achieving with their autopilot technology, already more than 6 times safer than the average driver. Looking at the amount of miles before an accident occurs, Tesla autopilot over 6 million, United States average, not even 1 million. And again, autopilot technology is still early days. And so even though they missed on earnings yesterday, which again riles up the bears, I think it was a great quarter because they did just actually report the highest quarterly revenue ever. And I want them to invest in Robotaxi and Optimus Bot. They've got the cash flow to do it. And that's how you outcompete other companies, by being able to invest more into research and development. You can innovate more. And they're pretty much the only company in the world that can sell EVs for a healthy profit, not even head and shoulders above the industry, pretty much in another world, looking at their free cash flow history against other EV makers. Tesla is the efficiency king, thanks to Elon Musk. And what you're looking at here is the latest images from NASA showing Mars. No doubt we'll see Optimus bots on there, maybe within the next 10 years, starting to build the first human bases, arriving there through SpaceX's Starship. And that brings me to today's video topic. There is no innovation without speculation, and there's no better example of that than Tesla. Because in its early years, the company wasn't profitable for a long time. Its future was uncertain. Wall Street called it overvalued. There was literally an army of Tesla bears, calling it Teslac, Tesla with a Q, because when a company's about to go bankrupt, it gets a Q added to its ticker symbol and can trade over the counter. They so desperately wanted Tesla and Elon to fail. They didn't care it was the most American-made car. They didn't care about the pursuit of clean energy. They just wanted to make money shorting Tesla to the ground. What ended up happening was a record amount of short selling losses because the Tesla army of bulls won. We bought into his vision, not just the numbers. And that speculative belief drove the stock price higher, which we can see here in the monthly chart. It was really that run up coming out of late 2019, 2020 into 21 that really destroyed all those bears that were just absolutely piling on, especially 2017 through 2018, I remember. And they thought they had won back in mid 2019. They really did. But it turned out to be a great buy the dip opportunity. And with speculators driving the price high, that gave Tesla access to cheap capital. Billions of dollars they raised through secondary offerings, strengthened their balance sheet, funded new factories, battery research, the global supercharger network. And so without that speculative frenzy, Tesla might never have scaled beyond a niche electric vehicle startup. It used market optimism as fuel for real-world innovation, also creating a halo effect that accelerated the entire EV revolution, pretty much caused the world to turn to EVs, all the traditional automakers being forced to invest and start building EVs. And that's the beauty of speculation. It amplifies itself, which drives progress. And no doubt speculation can overshoot, but it also builds the infrastructure and momentum for the next era of growth. And so without speculation, innovation would move at a crawl because the future needs funding before it becomes a reality. And this isn't just for Tesla and electric vehicles. Speculation has always been the engine behind progress. It's how every major technological leap was financed. The railroad boom of the 1800s was a massive bubble, but it left behind the tracks that connected America and other countries. The roaring speculation in the early automobile companies paved the way for Ford, General Motors, and the entire modern transport industry. The dot-com bubble was the same story. Wild valuations, but it funded the fiber optic cables, data centers, and software infrastructure that power today's internet economy. So bubbles are simply the price of ambition. They attract capital, talent, and urgency. And when they eventually burst, the excess gets washed away, leaving the real innovations standing stronger, more efficient, along with industry leaders ready to define the next era. And I believe Tesla will easily hit 10 trillion market cap before 2040, based on their huge growth in robots, not only in cars, but with humanoids as well. And just wrapping up today, looking at Intel, looks like we're in the full swing of a turnaround. The company just came through with a blowout quarter, topping revenue expectations and earnings, now saying they're having a difficult time meeting all the demand because of supply constraints. What a great turnaround for this iconic American brand that the country now needs to help reshore chip production, reindustrialize America, deleverage from China. Now with the full backing of the US government making a direct investment and management turning around the numbers, it's got all the ingredients of a classic turnaround story that could still go on for quite a few more years. Just looking at EPS coming in at 23 cents versus less than 2 cents expected. No real surprise to see the market trading higher after hours as I speak, up 7.3% in the post-session, and clear as day to see technically on the monthly chart the turnaround. Like I'd been saying at the start of this year, it was a great risk-reward opportunity because of the government backing and its strategic importance, along with depressed valuation. It simply wasn't on a path to bankruptcy. And I wouldn't be surprised to see Intel take out all-time highs in the next couple of years either, as it still only has a market cap of 178 billion. Nvidia moves more than that on some days, so plenty of room to catch up to the rest of the industry. And just finishing with a look at the VIX, still quite low here at 17. Bond yields firming going into tomorrow's CPI release. Be interesting to see what that comes in at. The dollar still holding ground, along with Bitcoin as well. A little bit of consolidation there for gold and other commodities like uranium. And the S&P 500 still just sitting a few points below all-time highs as we go into the Fed rate cut next week. Thanks very much for tuning in to Click Capital today. And just as a reminder, tomorrow will be my last daily market review for 2 weeks. All premium services will continue to run as normal, and I'll be back doing the daily videos on Monday, the 10th of November. So come back tomorrow because I'm going to share with you my strategy of where to hide out or at least diversify and hedge your portfolio for the potential ending of the bubble whenever that happens. That's all for today, guys. I'll see you back here again this time tomorrow. Cheers.